Good evening, everyone. You're all very welcome to this week's weekly webinar, looking at the key themes and events this week. Now, obviously, there's quite a bit to go through this week, so we're going to kind of take our time, go through each, I suppose, element of the markets step by step, and of course, looking at, I suppose, broader sentiment. So, really, the first place I'm going to start this week is obviously the shutdown in the US. So, obviously, last was what 35 days, 36 days, something like that. We've had rampage between the Democrats and the Republicans in all forms of the political sphere in the US. And of course, over the weekend, we started to get developments that there could be the end to it. And of course, yesterday, that vote came through. So the shutdown has definitely weighed on the data flow because, of course, we've had obviously 2 months of no NFP. We've had a number of other key economic data prints not being recorded and not being identified, obviously, by the different bureau within the US, obviously, broadly speaking. So I think from that perspective, it's really going to be very interesting to see how we get all of those data prints following that gap. So obviously NFP, for example, GDP, I think is going to be very, very interesting this week, or CPI, should I say, is going to be very, very interesting this week, of course, as is PPI on Friday. So really the kind of the fulfillment of those data flows, I think, is going to be important. I think what's also going to be important is that when we get these data prints, I think it's going to be really important for the Fed in terms of clarity of the policy, and of course really looking to see if there's any sort of lingering short-term effects, because of course when you've got no data prints flowing for potentially nearly 6 weeks, a month and a half, and then all of a sudden you're getting all that information, is there going to be any kind of lagging effects in the market? Are we going to get some negativity? And of course, if there is, that's going to affect sentiment. But overall, more broadly speaking, since yesterday, since that news broke, we have seen that risk-adjusted rally take hold. So obviously last week, last Wednesday, last Thursday, we saw it win. We saw it continue to win into the weekend. We saw Friday being quite negative, but we've seen that strong V-shape. We talk about these V-shaped moves quite continuously. And last week was the exact kind of same scenario. We saw that move. We saw that week lower, illustrated here on ES futures. And of course, since then, its markets are kind of showing a little bit more robust nature to the upside. So that's going to be quite important. So really the upcoming inflation prints, the labour data, I think, is also going to be very important, and also the risks that poses to the markets, because as I said, if some of these data prints comes out weaker than expected, should I say, that's going to have a consequential effect on market pricing, particularly in the short term. So you talk about your algos and so on and so forth. So with some US reports delayed by the shutdown, naturally, markets are watching for any, obviously, surprises. So whether that's downside surprises or upside surprises when obviously the data will resume. So that's really, really important, that overall, given the last 6 weeks, markets has actually done quite well, because of course we got to new all-time highs into Halloween, which was really kind of quite interesting, as we said, because we're already nearly a month into or already definitely 4 weeks into the shutdown. But obviously now it's really a case of, do we kick on? Can we progress higher? How does these data prints, as I said, like the CPI, the PPI, the unemployment data, reflect in terms of that? And as I said, really to see whether we do get that rally. Now, fundamentally, we obviously mentioned there about the Fed, and we talked about it over the last number of weeks, that with all of these data gaps, will that mean the Fed have to be a little bit more on the downside? Now, as we saw a cut in September. We saw another cut last week, 2 weeks ago, into obviously the end of October, beginning of November. Are we going to get our third consecutive rate cut? And of course, we talked about the lingering effects of that when we have higher rates. So this was obviously in the DXY, that first rate cut. And then, of course, over the last week or so, over the last couple of weeks, as I said, when we got that second cut. So in both scenarios, when the Fed cut rates in September and October, we've actually seen that dollar move higher. And we talked about this into the last kind of 6 weeks or so. We're kind of seeing that buy everything rally. So obviously as well, yes, short-term effects, there might be some negativity, but overall, this macro trend in the US equity space is still obviously continuing. So obviously from a global growth perspective, from a regional growth perspective in the US, obviously looking to make sure these data prints really continue to hold up. So obviously when we saw the GDP at kind of 3.94, 4.1%, the CPI numbers kind of ticking lower, that's going to obviously help with the Fed's policy in terms of bringing these rates lower. But outside of the US, of course, we've got UK GDP prints on Thursday, outside of obviously our traditional Fed speakers tomorrow. And then, of course, on Friday as well, we've got European GDP figures as well, in the midst of Chinese data as well. So we've got UK, Europe, US, CPI, GDPs, retail sales, PPI figures in the US as well. So we've got a couple of busy days this week, and we're really looking to see how does market turbulence obviously dissect from that volatility last week. Because as I said, obviously very, very clear downside progression. We talked about it last Tuesday. We got our gap fills across the board from the prior week. And all of those bottom levels that we talked about last week in yellow all played out to a T, right? You look at the NASDAQ, you look at the S&Ps, you look at Wall Street, they all formulated the bottoms. And since then, market upside has resumed on the upside. So for me, the next week or so is going to be all about filling the gaps with the labour, really kind of getting our heads around all of these labour prints, obviously into December. Really obviously looking to see if there's any sort of consequential effects. So let's say if prints are negative or positive or beating or really missing expectations, how does that fare into the data perspective? And then of course, obviously, as we move into year end, we've got confirmation already at the last Fed meeting. QT is ending on the 1st of December. It's a case of when does the Fed resume QE, and of course liquidity provisions increasing into the back end. So that's going to be important. So central bank and policy signals for me is going to be really important into year end. Really, if we're going to see the S&Ps continue to kick on, the NASDAQ, the Dow Jones, European equities to try and get a second leg up, and of course even in other eternal assets like gold, crypto, these start to see if a further filtration of upside progression if we get a more expedited QE stance by the Federal Reserve. So for me, obviously the data prints is important over the next couple of weeks. In the midst of everything that's gone on for the last 5 or 6 weeks, clarity, I think, from the Federal Reserve and other major central banks, I think, is going to be important as well, and how they're navigating around these data gaps. And then, of course, obviously in the back end, what are we seeing the most influential aspects of the market at the minute? AI, tech. Will that continue to remain dominant into year end? When you look at the likes of the pullbacks last week with Palantir, Nvidia showing really, really strong downside pullbacks. But that's the nature of the beast at the minute of the stock market. When we get these upside progressions, they're very, very bullish to the upside. But when we get those knee-jerk reactions, we're seeing those 3, 5, 6% pullbacks in a given couple of trading sessions or over a period of a trading week. So that for me is also going to be important. And then, of course, looking at the macro side of things, and I think understanding the risk dynamic, I think, is also very, very important. Mapping that risk out, I think, is ultimately so important, and highlighting the cross asset variance factors. So obviously what we mean by that is obviously looking at the VIX in terms of the short-term volatility, something that we've done all year and we'll continue to do into 2026. But also looking at those other assets. So obviously gold, which we've seen get that healthier leg up, that stronger dollar play, which we've talked about more recently, and of course this continued kind of buy the dip scenario. We saw it in October, we're seeing it again in November. Are we going to get that continued theme into year end? So a lot of different things to consider as traders, as even investors. I think it's important to just be able to separate the forest from the trees, or the wood from the trees, and be able to actually look at, right, what are the key kind of distinguishing factors. And as I said, these are some of the main things that we're looking at. So actionable implications, I think, is important. Obviously the hedging of the tech, see if we get more downside, obviously in the AI risk, in the AI tech sector, I think is going to be important, considering obviously the weighting that we're seeing in the S&Ps, in the NASDAQ, etc. And then of course the yield moves, obviously with the 11th of November, yield treasury markets closing today. So of course that's going to be an interesting factor into the rest of the year as well. And obviously watching the Asia-China debate as well, in terms of obviously some of the deep declines that we've seen in Chinese output, but more broadly how progressively well the Chinese indices have done through the course of the year. So there's a lot of different variances or variables to take into consideration. And I suppose from our perspective, it's important to be able to map these out, be constructive, have clear realizations of separating and looking at the bigger picture, but also being uniquely aware of these short-term lingering effects as well. So as I said, this week, pretty heavy week. Tomorrow, not expecting too much. Now, of course, today we did have the ZEW in Germany. Very, very disappointing numbers. The ADP employment change we did get today, it proved to be 11,000 down, but again, I think it's going to take us a couple of weeks and probably maybe a couple of months to really figure out, was there any material significant changes in those 5 or 6 week period when the markets were down. Okay, and then as I said, tomorrow a bunch of Fed speakers. So we've got Williams, Paulson, Waller, Bostic, and Moran and Collins all on the wires tomorrow. In the midst and following, obviously, the Gundos and Schnabels speaking tomorrow. And of course, German CPI data, Harmonized Consumer Price Index, is going to be quite important as well. German CPI data. Now, broadly speaking, if you're looking at European growth, German inflation is expected to be around kind of 2.3, 2.5% year-on-year average. German growth is around about 0.8%. So obviously, to see growth at 0.8% while inflation is at 2.5%, how is that shortfall going to be made up? And I think that's also important, particularly when you look at the European side of things. And of course, we look at the European EURUSD, and of course, we look at the DAX later tonight. Now, obviously, Thursday, as I said, GDP figures in the UK going to be quite interesting. Year-on-year growth is expected to be around 1.4%. Month-on-month, 0.2%. Q-on-Q 0.2 as opposed to 0.3 previous. So basically Q-on-Q and month-to-month is expected to be slightly lower. But for me, I think the bigger consequential effect is with the Labour government, rising taxes has been clearly evident. So now I read an article today that they're expected to tax people who want to leave the UK 20% on their wealth as an exit tax. So basically saying if you try and flee the UK and you're a high net worth individual, you're going to be taxed to the hilt. So really the UK folk are really kind of getting what they paid for with the Labour government. Labour traditionally are always a high taxing policy party, and that is definitely obviously visible, as I said, under the Starmer Reeves Parliament in the UK at the minute. And of course tomorrow or Thursday afternoon we've got more speakers on the wires, but of course the CPI one's going to be quite interesting. Now, with the weaker oil prices, oil prices rebounded a little bit since the middle of last week, but overall really since the last 2 or 3 weeks oil prices is down narrowly. It'll be interesting to see into year end. Seasonality factors, will we actually see oil prices continue to drop down lower? We would have expected it probably to break down lower if it was going to break down by now. It hasn't really done that. We've seen a little bit of robust move higher, and of course we'll talk about that later. So obviously from a food and energy perspective, interesting to see if there's any lingering effects, but also purely from the headline, excluding core and just looking at the headline more broadly, at 3%, both of them are pretty much in line. So really from that perspective, do we still see the inflation prints at kind of like that 2.93, 3.1% level, or are we actually going to start to see inflation prints drag lower? Now, we've also seen over the last week this potential stimulus package by the Trump administration that he's looking to give $2,000 to basically those of lower middle income in the US as basically a gesture of goodwill, really against the offsetting income that they're earning from the tariffs. Now, on face value, the tariffs is quite of an interesting dynamic because yes, its goal is, from an exterior point of view, it's really to show America as a show of strength. We are the major consumer economy globally, therefore you are going to bow down to us because of course we are going to dictate the price that's going to be paid. And then also you've got the manipulation by other parties, what's happening in Europe, what's happening in China, particularly in China with the duplication element in terms of knocking off a lot of the main US based goods. So obviously that's an important factor, but more broadly beyond that, it's actually when you look at the cost of goods. Now, naturally speaking, the cost of goods in the US has gone up somewhere between 3,000 to 5,000. So getting $2,000 back from President Trump as a gesture of goodwill, so to speak, still probably leaves a lot of households still naturally down. But when you factor in that the big trade over the last 10 years has been rising global debt, has been a currency debasement every year of somewhere between 8 and kind of 10%, naturally, you're kind of expecting the natural price of goods and services to increase, or what we're seeing more commonly over the last 4 or 5 years in terms of shrinkflation really come back through as well. And we're kind of seeing a bit of both, where maybe multi-packs are going from 6 to 5 or 5 to 4, or the existing product of the 5 or the 6 pack of a certain good is maybe 50 cents more expensive at retail level. So those are the definite elements. It's not just attributed to tariffs, in my opinion. It's actually the broader, really the rising global debt and how central banks and governments navigate around that rising of global debt. And obviously the best way to do that is through currency debasement. So you debase your currency, you make it weaker, you then allow for, as I said, something that we're obviously going to see through the end of the year and into next year, this refinancing of those debt obligations at potentially lower levels as well. So really an important point to note. But moving out of that, moving back to the calendar on Friday, we've obviously got the PPI numbers and the retail sales in the US. I think it's going to be quite interesting. So into Christmas, will we start to see a pickup? Probably too early to tell in terms of the retail sales, but Black Friday is just a couple of weeks away. Then, of course, we've got the Christmas rush. So we're really going to see January into February where the retail sales figures are actually at in terms of that consumerism perspective in the US, and seeing actually is there any lagging effects on the consumer, or is consumer demand in the US still resolute and still holding up? Despite obviously the tariffs, the geopolitical space, and everything else that's going on in the background. So really important narratives and things to focus on. A busy week this week with the calendar, and as I said, it's really gone back to that idea of mapping out the risk, and something that we've done quite well on over the last number of months and really through the course of the year, that when we do identify these pullbacks, knowing it's a natural course, natural symmetry of the markets, that when markets extend, like what we saw over the last few weeks, there will be a period, there will be a counter trend, and we're calling those, we're nailing those, and we're getting those dip opportunities. So really the interesting narrative for me this week is moving outside of that V-shaped bottom that we saw on Friday into obviously the bank holiday weekend, or into 11/11 today with Remembrance Day, is obviously these gaps. So Sunday night into Monday, or Friday into Monday, we've actually seen some of these markets actually gap higher. So is quite interesting because, of course, we had that V-shaped bottom in the S&Ps pretty much across the board. V-shaped bottom on the NAS, V-shaped bottom on the Dow. Very, very evident. Some of the gaps have filled, so obviously Dow has filled, and it's really just kind of ballooned higher today. So that was an aggressive break today above that 47.4, 47.5 handle, which we talked about last week. And from there, it actually didn't really look back. It was just straight through from about 1 o'clock, half one, really into the open, and then from there just really continued to echelon higher back into those highs. So it's coincidental that despite all the negativity over the past few weeks, despite the corrective nature of the markets, within 2 or 3 trading sessions, Dow Jones is back to all-time highs. So really as well, that's going to be an interesting narrative, that obviously the NASDAQ, for me, obviously the S&Ps as well, gapping higher, creating that gap, not really fulfilling it. Is there any sort of downside risk? So this is for me the danger of when you have 6 or 7 weeks of no data. Is there any data prints that disappoint? And if there is, I would look for those gaps to fill. But at least in the short term, that exuberance, that short-term momentum is still taking to the upside. S&Ps is at highs of the day. The NASDAQ is at value area. It's not at highs of the day because it's kind of come off that area from last Thursday, which it sold off from around 25,700s and change. But overall market pricing structure is pretty well, considering the volatility we had last week, some of those lingering effects, and of course looking at that in the back end. And as I said, the central nuance to all of this is understanding risk sentiment first and foremost, and understanding volatility. When volatility starts to increase, you get, like what we've seen last week, what we saw in October, you get those corrections, you get those sharp sell-offs, temporary sell-offs in the markets, and then when that volatility curve starts to level out, then you get normal service resuming, and these markets ticking higher. And as I said, the VIX is the prime example of that as you look at pricing structure. Now, particularly on the session, if we just look at this focus on the session again, it kind of alludes exactly to that. The VIX is off just a little over 1% today. All your risk denominated assets, DAX, even your soft commodities, the S&P, some of them are up only ever so slightly, some of them are up a little bit more, steepening. So let's say, for example, the Dow Jones, the Euro stocks, and even some of your soft commodities all doing quite well. So again, it's kind of illustrating that. The only really somber mood is the fact that the crypto space is obviously still struggling. And I think that's probably in no surprise due to the upside spike that we've seen in gold pricing since the weekend, because of obviously when you see gold pricing, it's probably been the favored hedge rather than seeing obviously that traditional when gold is up, BTC is up, but that's not necessarily always the case. So obviously understanding the risk mapping, as I said, is important. Cross asset risk factors, I think, is really, really important. So obviously corrections in the yield story, corrections in the dollar, rotation into cyclical value, safe haven flows, and then of course understanding, as I said there a moment ago, understanding the risk dynamic V and how does that factor into market conditions. So overall this week, I would have a word of caution for those gaps. So the gap on the NASDAQ around 25.2, the gap on the S&P around 67.50, those for me are pullback opportunities if we are to see a little bit more downside negativity, or at least short-term sentiment in the downside progression. Those would be areas that I'd look out for. But really and truly, fundamentally, given of course we had that spike on Friday on the VIX into that 2022 handle, something we've talked about quite a lot over the last number of weeks and months, and then of course that immediate V-shape movement in the stock market was perfectly timed with the evidence of this apex in the VIX, and of course what happened from there, VIX just completely folded on itself and has continued to remain on the back foot back into this 17.5, and that 17.5, that 16, this was the kind of the period of consolidation into the FOMC. This was the area that we kind of watched closely because it was kind of replicating a lot of the consolidation that we saw in September before we had that massive spike. And then of course we had a similar spike. It just took a few extra days for it to develop, where we've gone from kind of 16s to 22s, 23s, and then ultimately back down, replicating, but to a lesser degree, not as sharp as the Friday the 10th of October correction and Friday the 17th of October correction on the VIX, where we had that massive move higher and ultimately moving back down into this range. So for me, this secondary range I think is going to be very, very important. But ultimately it's how does the VIX navigate or continue to navigate lower into that 16 print, or more likely back into these structural yearly lows from August in particular, but pretty much through the course of the year in that 15, 14.5 print. So for me, that 17.5 has been a short-term kind of break or bend scenario. So if the VIX continues to remain in under 17.5, yes, you might have a short-term reaction. So let's say if we pop to 16 and pop back up, you might get a little bit of a knee-jerk reaction. But overall, 17.5 for me is structurally quite interesting as we move into year-end on the VIX. And as I said, if we do see further declines in the VIX over the next couple of days, moving back into that 16s, well, that just means you're going to get that continued grind higher. Probably similar to what we saw in October when we had that bottom. Then, of course, we had that grind. We faltered. We had a little bit of a period of consolidation, and then we kicked on. We then, from the 23rd to the end of the month, it was just grind, grind, grind. And then, of course, we gapped, we grind, and then we formulated tops, or current market tops, into month end. So that's kind of the thing to look out for. Do we get a gap fill on the S&Ps, on the likes of the NAS? Do we get a short-term pullback? Do we get the Dow to potentially reject from these all-time highs at around 48 or 48.1, 48.2 and change? Or do we see market participations take these markets obviously off of those levels, and as I said, create those corrections? So that's really the area to look out for on the Dow. Symbolically as well, same as the notion here to see the NASDAQ fill the gap and then obviously try and go higher from there wouldn't be completely inconceivable, because as I said, that's the type of formation that we had in October, right? We formulated the lows, we got a 2 or 3 day bounce similar to this, you can kind of see it yourself. We pause, consolidate, we get a short-term rebuff, and then of course buyers comes in. So that would really be a case of short-term rebuff, buyers comes back in at a lower level, fill the gap, and then look to obviously take this higher. But that is contingent on a few different variables. As I said, the data prints for me is fundamentally important. The macro side of things, the risk map of how market participants see the current risk profile, and then of course, as I said, factoring into all of that, the volatility curve. So hopefully that allows us to kind of have a deeper understanding of how negativity and volatility can affect the markets on the downside, understanding potential for those corrections, but then obviously looking at, if there is those corrections, what is the next structural play? And as we're in a long-term bullish trend, we should continue to do so at least for the foreseeable future, it's really a case of finding those dip opportunities, like what we saw last Friday, like what we saw across the board with the S&Ps, the NAS, the Dow last Friday off of those key pivotal levels. Can we see a same again? So again, can Dow react or sell off of this 48,000, go back down to 47.5, create that dip opportunity, or even revisit some of the value areas that we saw from 2 weeks ago, right? You've got that value area here. Look into month end value area. Where are we looking at? 46, 47, 600, 47, 7. Could very easily pull back into some of these lower bounds, create that next move higher. So those are the types of plays that I'd look out for. Unless it's a case that the VIX just completely folds over. And what I mean by folding over is continues this aggressive sell-off to the downside. Well, then you know that the likelihood of a short-term correction play is probably more unlikely, as this market is just going to continue trickling higher in that regard. And then, of course, you're going to have to potentially look at new all-time highs again. So that's kind of where we're at in a broader perspective of things. Kind of, as I said, kind of a lot to digest over the last few weeks, a lot of fundamentals, a lot of moving parts. Getting those data prints back in, I think, is actually going to be important for the markets, because we can actually kind of move forward with a bit of clarity. I think a lack of clarity is where the uncertainty comes in, where these spikes and the volatility comes in, and where these kind of pullbacks come in. Because, of course, last week, Thursday, Friday, we were very negative because there wasn't really any update. There wasn't really any kind of clear mindset of when this shutdown was ending. There was 15 or 16 votes. Every couple of days, the vote was rejected. And then all of a sudden today, we got a little bit of progress. So from that perspective, it's really kind of a case of when markets have more clarity, they tend to have a little bit more cohesion, a little bit more structure. And it's actually, you tend to find it easier to read the market. But when you have unknown uncertainty, that's when things get a little bit more tricky. So just be mindful of that. So that's kind of where we're at in terms of the S&Ps, the NAS, the Dow. Now, of course, we will be on board Wednesday. We will be on board Thursday. So if there is rejections, if there is structural pullbacks, if there is volatility associated to the data prints, we will be on board to be able to digest this movement in real time and be able to update chronologically as the things develop. And it's the same across the board. So whether it's in the UK, whether it's in Europe, whether it's in the US, again, even with the DAX, V-shaped bottom like we saw on Friday, and of course the FTSE V-shaped bottom on Friday. You only have to look at the FTSE moves. Could this be a precursor for what we could see in the S&Ps, the NAS? We get that Friday low, we kick on. Could very easily see Dow doing the exact same thing tomorrow if the volatility continues to run over. And we could very easily see the same thing in the NAS, in the S&Ps, to what's happening in the FTSE. We break down, we get our V-shaped bottom, and then all of a sudden what happens? We take out the new highs, and we ultimately springboard higher to a higher degree. So those are kind of, it's important to kind of look at things as wide open as possible. And then, of course, as I said, some of these other macro factors in terms of the central banks, Fed cutting rates in September, we saw it go from 96.5 to 100. Over the last couple of weeks, we've seen it go from 98, just underneath 99, up to 100. So those are the precursor elements as well. Now, the DXY side of things is really very interesting at the minute, because for me, we're obviously seeing the euro dollar break down structurally. So you've obviously got this trend. It broke through the 17s, created that dip opportunity, went to 116s and change, went to 115.50, got the pullback, got a secondary pullback, made new structural lows. So really, from my perspective, it's a case of every dip that we see on the DXY, like for example what we saw in the middle of October, like what we saw in the middle of or latter end of September, like what we're seeing over the last week, is that the next buying opportunity? Now, ultimately, what's quite interesting here is that the DXY very clearly failed last week at this 100 top, and that is the short-term daily top. So obviously apex down, back down, structural lows, fundamental event as bottom, and then of course last week or last 2 weeks, fundamental continuation and trend all the way into this highs, but doesn't navigate through it, and now we're getting the correction. So for me, I think that DXY around that 99 print, 98.75 into 99, I think is going to be very interesting this week. Obviously we're midpoint at the minute, in the sense that the DXY is obviously broken up, it's rejected, it's faltering, it's in a kind of a weak kind of correction play. Can it continue to springboard shorter term lower lows, lower highs back into this structural area from obviously the previous FOMC, and really looking at that being the next catapulting long on the DXY to potentially go to 101, 101 and a half. And if so, does that create the opportunity then for the euro dollar in its short-term V-shaped bottom as well? We're seeing a lot of V's to correct back up and really kind of mitigate this short-term sell-off that we've seen from Halloween, prior to Halloween, FOMC, into that 14.50, 14.75 bottom. where we're back into 116 today. So even when you look at the nuances from session to session, you can actually see that there's still quite a lot of volume up here that we can potentially go for, particularly when you look at that 116.50 handle. So between 116 and 116.50 handle could very easily continue in the short-term bull case. Obviously, you've got impetus last Thursday, continued Friday, period of consolidation Monday, aggressive move higher today, really pulling back to kind of break out or retest this kind of structural 2 or 3 day consolidation. So even from there, could it be conceivable that we actually see euro dollar probably fade a little bit back into this 2 day value area around 15.50, 15.75, and then have try one last go into that 116.30, 116.50 handle? Could very easily happen, and then you're really seeing price action mitigate that full sell-off, corrective move, end of structure, DXY bottoms, and then you're obviously looking for that next wave structural of decline to the downside. So that's what I'm looking at personally. Whether it happens or not, let's wait and see. As I said, this area here I think is going to be very interesting over the next kind of day or two. Obviously, as I said, the fundamental events, the CPI, the PPI, Thursday, Friday, those could be the catalyst to see one final move, shake out, one final pullback, shake out, and then obviously try and progress higher. But again, let's see how that happens. A similar type of scenario with GBPUSD, albeit the cable is much weaker than the euro. So obviously, when you look at the structural sell-off from the end of October to where we are now, even in the correctional sense of things, so even if you're using like a simple fib just to understand the degree or percentage of the retracement, you can actually see that even now currently we're at 50% of the retracement from the end of October, whereas if you compare the same structural decline from the same period, you will see that the retracement in cable is not 50%, it's probably around about 30, 35, and in fact we're somewhere between, we're probably around the 40%. So it shows that there's a little bit more of an upside there in cable. Whether we get it or not is going to be very interesting, and whether we get that extremity in terms of a pullback into this value area here in yellow between the 786 and really the 1 is going to be very interesting, and that for me is up around 133. But we're at 130, we're failing at 132. Whether we get another 100 points or not is very interesting, probably more unlikely. But for me, the easier play is probably waiting to see, can the euro dollar get a little bit of a deeper retrace into that fibs, but also more broadly against the existing residual trend, and then look for that being the next wave lower. So keep an eye on that one. Euro cable, you can draw the structural ones out. I'm really looking to see kind of how extreme it is now. The 50% fib, it's come off it yesterday. You'd like to see it a little bit higher. 61.8, 707 is always good. 707 is the square, so if you're ever wondering the 618 and the 786, the 707 is the square of the two. So it's kind of like another level to focus on if it's a case that that's something that you incorporate into your own strategy. In terms of the dollar yen space, before we kind of move back into gold and the commodities, dollar yen had a very, very strong period of consolidation through September. It obviously gapped higher in October. We never filled that gap like we did with some of the other assets, like we did with the DXY. It has just continued to move higher, and it really would not be surprising if we saw dollar yen following that break and hold above that 151, 152 handle, really to kind of springboard higher into those high 150s. Now we're 154 at the minute. We're at a short-term top. If you look at price action on the dollar yen, really for the last 2 weeks or so, dollar yen has actually been pretty consolidated. So even again, you can draw it out in this region between kind of 153 and 154.50. Obviously, break of tops allows the trend to continue. But then you have to really go back up into that weekly structure to see, right, are we getting a third leg higher off of that third leg lows that formed from those low 140s, and just basically back up in. But what I'm more interesting is the fact that we've had cemented lows, you've got lower high. If this trend is to continue, you're probably not going to get a new high above the 158 handle, but really wouldn't be surprised if we were to see, let's say, 156.50, 157. And that, of course, is another couple of 100 points above where price is currently trading at. So let's keep an eye on dollar yen as well. I don't trade dollar yen that proactively, but again, it's worthy of note. The moves in the FX markets are there, they're visualized, they're quite extreme, so there's something to potentially take advantage of. But obviously, from a daily perspective, you obviously want to see this daily top being taken out, continue the trend, and ultimately progress higher. And I think for the dollar yen to go to, let's say, 156, 157, you're really looking for that. As I said last week, you're really looking for that. excuse me, that DXY to come back up into that 50-week moving average, which is going to be somewhere between 101 and 102. It's roughly trading around 101.50, 101.60 at the minute. So it does show that there's potentially a little bit more of a run up in the dollar into Christmas, which could potentially allow that dollar yen into that third top again, 156.50, 157. So let's keep an eye on that one. There is merits to understand for the DXY to move higher with the dollar yen, but obviously let's see how things develop over the next, as I said, number of weeks. So short-term perspective is pretty clear there on the week. Medium-term perspective also pretty clear. Longer-term perspective also defined as well. Any questions on that, please let us know in our community. And then really the last port of call tonight before we move into the crypto space to finish is this massive gold rally. So over the last kind of few weeks or so, gold has been very condensed, right? 3,900 lows, 4050, 4040 approximate highs. I've mentioned it in a few of my daily market notes over the last week about how the price action was quite condensed, it was quite curtailed, it was very consolidated, it was very back and forth, until of course we had a little bit of clarity. Sunday night into Monday, markets opened up, gold went higher. It took out the highs at 4040. From there, it just really hasn't moved anywhere else other than bullish. And it's kind of very similar or very atypical to the types of move that we've seen in October, Friday the 10th of October, when we went from, again, underneath that 4,000 level, all the way up to 4150 within a couple of trading days. And a similar type of scenario here. We've gone from 4,000 up into 4150 or a little under it. A little bit of a correction today overall, but again, gold prices again into tonight's close, moving back into the value area, and really wouldn't be surprised if this gold trend has goes again, right? So above this 4150, 4175, and ultimately tries and kicks on to 4350. If that is the case, if you're probably looking at the markets, you're probably going to try and copy or duplicate this type of aggressive move, break up, pause underneath, get a little bit of a hold, break through, continue, break and retest, and then ultimately continue the trend higher. So that could be a potential scenario to look out from gold. Look to see it break through, cement a hold obviously above it, and then obviously look for it to kick on if that's the type of trend that would look to develop in gold. And then you're looking at a broader weekly retest of those highs, and then when you fade it back and you look at it in earnest, remove all the drawings, you can basically see price actions coming back up to retest those levels. So higher time frame looks pretty clear, daily time frame interesting, 4-hour time frame off of that short-term top as we've discussed, and then you're looking for the shorter time frames over the next few sessions, looking to really break up, hold, and continue the trend higher. So that's kind of what you're looking at there in gold, but obviously not I suppose ignoring the fact that we could actually reject off of this 4150, 4175 like we did last week, but given the impetus and given how strong that break it was over the last couple of days, could very easily just continue smashing through like what we saw in October. Now, oil prices, right? So the oil price is kind of, this is really what I wanted last week. We got the breakdown and we're thinking, is this it? Are we off to the races? And then by about Thursday afternoon, no, we went off of that 59 handle all the way back into 60, and really replicating some of the consolidation that we saw early on Thursday, some of the consolidation we saw on Wednesday, where markets remained between 59.50 and 60.50, and we replicated on Friday, and then we replicated on Monday. And when I seen that 2-day consolidation period, that for me was like, these shorts aren't continuing to exacerbate as of yet, because when you have consolidation like that, when you get a breakdown like that and you get an immediate kind of V-shaped corrective move, if it's not immediately reacting off of this and creating a new structural low, the trend ain't going anywhere. And that's exactly what happened. It's just kind of continued to faff about on Friday, same again on Monday, and then of course today we've actually obviously seen oil prices move back into that 61 handle again, but ultimately under that 62s. We haven't taken out the highs from that yellow range, that consolidation period, or we haven't taken the absolute highs that was formulated at the end of October. So for me, it's apex up, short-term lower low, short-term lower high, short-term lower low, short-term lower high, and really this area around 61, 61.50 is secondary note to see if there's any sort of selling. Now, there's a little bit of a reaction so far tonight, but I want to see if there's anything more sustainable from that. And then that would potentially allow for a second opportunity to go short. But for me, the oil price is a little bit sticky at the minute. We're not getting that breakaway price of structure as of yet, which is a little bit of concerning. That price action could very easily just create a period of continued consolidation here between kind of 59 lows, 59 mids, up into that 62 handle, where price action rejected on the 24th of October. So just be mindful of that. Same type of structure in the UK oil as well. I don't tend to I'll trade US over UK, but almost a unilaterally similar structure. It broke down Friday, V-shaped move, period of consolidation. Thursday broke down, period of consolidation Friday, period of consolidation Monday, and it's back up into these equal highs of which we've rejected. So just keep an eye on that. 65.50 on Brent. 61.50 on US. We'll continue to monitor that. I'll monitor it in the morning as well with our daily market note. Really worth keeping an eye on that. And then, as I said, last but not least, for tonight's call is the crypto space. So obviously BTC getting a nice rally yesterday. I'm just going to disable this for a second. Oh yeah, nice rally obviously. Friday, Saturday into Monday, nice corrective movement, but we're on the back foot again today. So it's interesting today with oil prices remaining sticky, with the gold prices moving higher. BTC is again struggling, but holding, for me it's still holding under that or above that kind of 101 handle, short term top at 107. So we're basically getting an unwind of this impetus move that we saw from basically Thursday, Friday off of those lows. So structural movement, prices coming back down. Interesting to see what happens from that. 4 hour structure pretty clear, daily structure back into those lows. For me, what's important is the 50-week moving average, right? So this is something that a lot of analysts and forecasters are looking at, obviously from a trend structure. 2023 market lows into 2024, strong progressive move, bounced last September, bounced again in April of this year, structural decline, pull back into it again. I think the next few weeks is going to be very, very key to see whether this is market top, or whether it's basically a repeat of what we saw over the last few weeks, where markets comes into it, holds above it, and then obviously tries to kick on. But as I said to a few folks, I think BTC still has more room to look. If you look at the macro side of things, the liquidity side of things, QE is going to start, QT ending, continuation of cutting rates, the easing of liquidity conditions on the macro side of things, plus the broader economy is, as I said, still holding up pretty well. You'd actually still probably have to favour BTC moving higher short term. So over the next kind of 6 to 9 months, the potential for us to see maybe 160, 180 wouldn't be completely impossible. But as I said, the next few weeks I think it's going to be important to make sure price structure holds above that 100, 101 level, but also symbolically that weekly 50 moving average as well. So keep an eye on that one there with BTC. Ethereum obviously got that equal tops correction from 4,800 we've talked about over the last weeks, all the way back down to this yellow area. This yellow area was buying zone for me, so between 2,800 and kind of 3,100 was the area to look at. Yes, we got it on the 4th. We've held above kind of 3,200 for all of last week. We've got a spike to 36. We're moving back down. Similar to BTC, short-term impulse, short-term move back in. Probability is we see 3-2 again. And then it's a case of, does price structure actually try and come for the wick? If it comes for the wick, then you're looking at short-term new lows, more pain, and then you're looking more corrections in the likes of that as well. And of course, when you look at total 1 with the crypto market space, obviously rejecting 3.6, it's moving back into that 3.4 territory. Are we going to see new lows again? If that's the case, look for 3 to 3.2 trillion total market cap as being a tested area in terms of overall market value. So that's kind of where we're at on that. In terms of where we finished tonight, VIX is down, Bitcoin is obviously down, NASDAQ is actually slightly flat, but we've talked about that in the session. It's off this really the open, but it's at value area, so I'd expect to probably remain where it's at into the close. And then of course some of the other notes worthy of note, obviously European equities doing quite well, oil doing quite well, gold obviously a big winner today. or big winner or since the beginning of the week, but really whether it continues or not is obviously next couple of days will pay dividends on that, and then some of those softer commodities as well. All right, so that's where we're at tonight, folks. I hope tonight's call has been useful. Looking at it on multiple different perspectives. We'll be back tomorrow, 2:20 p.m. UK time, and then of course on Thursday as well to round out the week. But really interesting couple of days, and obviously let's see how does the markets develop over the next couple of sessions as well. All right, thank you everyone. Have a good one. Trade safe. Thank you very much.